This video explores the history of credit cards, from innovative banking experiments to the global payment revolution that transformed consumer finance. In the 1950s, most American banks were small. Bank of America stood out with over 800 branches and pioneered consumer lending, including mortgages and auto loans. They also invested early in computers and advanced telephone networks. The Bank Americard launched in 1958 with a mass distribution to over 2 million customers. It was the first true credit card, charging interest on unpaid balances. However, many consumers didn't understand the interest, leading to significant defaults and initial challenges. Bank Americard's innovation was charging interest on unpaid balances, defining the modern credit card business model. The revolutionary unsolicited mass mailing of over 2 million cards changed banking forever and later faced regulation. Bank of America initially suffered significant losses, with default rates reaching up to 22%. Despite the struggles, the bank remained committed, refining its credit policies and building the foundation for the modern Visa payment system. To expand beyond California, Bank of America licensed the Bank Americard name to banks in other states and abroad in 1966. By 1970, it divested ownership, forming an independent venture that rebranded as Visa in 1976. In 1966, a consortium of New York banks formed the Interbank Card Association, or ICA, to compete with Bank of America. ICA grew quickly and rebranded in the late 1970s as MasterCard International, establishing the two-player dominance in card networks today. Credit cards were slow to catch on because transactions were expensive to process. Before computerization, businesses had to verify every purchase over the phone and process paper receipts, leading many to charge a fee that discouraged use. Following Bank of America's lead, other banks mailed tens of millions of unsolicited credit cards. This explosion of cards prompted congressional action to regulate the rapidly growing industry. As credit card use exploded, the government stepped in. The Truth in Lending Act of 1968 required clear disclosure of credit terms. The Fair Credit Reporting Act of 1970 regulated credit information, and the Fair Credit Billing Act of 1974 protected consumers from unfair billing. The mass mailing of unsolicited cards created widespread fraud. Congress banned these mailings in 1970 to protect consumers. A temporary ban on consumer surcharges in 1976 made credit card purchases more affordable, though surcharges later returned. Before 1974, single women often needed a male cosigner to apply for credit. Married women needed their husband's signature, and the card was often issued in his name, limiting their financial independence. The Equal Credit Opportunity Act of 1974 was a landmark for financial equality. It finally guaranteed women the right to obtain credit in their own name without a male cosigner, transforming financial independence across America. The credit card legacy includes a strong consumer protection framework and the creation of dominant global payment networks like Visa and MasterCard. This industry transformed financial equality for women and laid the foundation for today's digital payments. Thank you for watching. The history of credit cards reflects innovation, challenges, and the evolution of consumer finance.